Today's topic is year-end planning now for businesses. We have two presenters, both who have presented for us in the past. Mariana Moghadam has presented on business topics, especially real estate and 179 and other planning topics in that area. And Doug Finkle, who's a director, has presented with us a lot on the ERC. So I'm going to turn it over to Mariana, and please, Mariana, take it away.
Good morning. Thank you for spending your morning with us. We are going to be talking about the benefits of tax planning and hopefully try to give you some ideas on how to minimize your taxes. We'll go over some federal tax issues, state and local tax issues, international, and the most recently passed act, Inflation Reduction Act, and how you can look into what's ahead for you in 2023 and hopefully what you can plan for it in 2022.
So what are some of the benefits of tax planning?
Going back. Go ahead. Yep. Sorry.
No, keep going.
So what are some of the benefits of tax planning? One is you want to manage your cash flow. So how could you manage your cash flows through tax planning? Next slide. So some of the ways you could manage your cash flow is you want to plan for your taxes. So you want to look for ways to reduce your current tax and, if possible, to defer taxes to the future. That's the best way to manage your cash flow. I'm going to go over a number of methodologies you can use to do that. So in essence, you want to maximize your deductions. So any deductions you can get in the current year that you're entitled to, or any deductions you can advance into the current year. For example, if you're a cash basis taxpayer, if you pay some of your expenses before year end that you would otherwise pay in January, you could get the deduction in the current year because you're on the cash basis. You want to take advantage of available credits, research and development credits, work opportunity credits, employee retention credits, which we'll talk about later. And you want to try to defer income to the future if possible. So again, maybe if you're a cash basis taxpayer and you could push that receipt of a sale into the next year, that will defer it into the following year. You want to minimize your capital gains by offsetting it with any capital losses available. And you also want to minimize, if you're paying your estimated tax, you want to make sure that you're not underpaid during the year, because if you're underpaid, you're subject to underpayment penalties. So ways you could do that is, one is there's different methodologies on which to base your estimated taxes. For individuals, you either have to pay 90% of the current year tax, or for most taxpayers, high net worth taxpayers, 110% of the prior year tax. For non-high net worth taxpayers would be 100% of the prior year. And if you do that, then you can minimize penalties and not get any penalties, because under either method, you're penalty proof. For corporations, you either have to pay your tax based on the safe harbor prior year or on the current year. And in the case of large corporations, those are corporations with over $1 million of income in the previous 3 years. You can only safe harbor based on the prior year for the first quarter. Then after that, your options are either to pay based on your earnings every quarter, or you can use an annualization method, which means that you would just pay in the quarter based on the income for that quarter, and you would annualize it out to the end of the year. So if you follow those methodologies, if you're a corporation or an individual, you could avoid paying underpayment penalties. And the biggest reason you want to make sure you plan for taxes, you want to manage your cash flow. So if you have a big estimate that's due in any particular quarter, you want to make sure that you have the funds available through planning, or if it's a big enough tax, you might have to borrow, or to make sure that you have the money to pay your taxes and not affect your other operations in terms of your capital expenditures. Next slide.
Yeah, Doug, real quick before you jump to the next slide, Mike actually brought up something yesterday during the presentation, which is profound, is that the penalties and interest for underpayment is generally it's based on the interest rates that are there, not directly the same number, but driven by it. And with the rates going up, and Ken mentioned, one of the attendees mentioned, that the prime did go up 0.5% yesterday. So that means that the underpayment penalties are or can be getting significant now. Where in the past, when prime was real low, people like, you know what, I'm earning more, with investments. Well, it might not be that way now, so be very careful with it.
Yeah, no, to your point, Brad, for 2023, they just announced the first quarter underpayment penalties, and they're somewhere between 7 and 9%. So with inflation, they are ramping up the penalties for underpayments.
Wow. This is going back to the Carter era in the late 70s, early 80s. Wow. Holy cow. All right.
So now we're going to talk about some, from federal perspective, ways to, either defer taxes and, minimize your ultimate tax liability. So next slide. So these are accounting method options that are available. And the first one, the small taxpayer methodology, is available to taxpayers who had average annual receipts of $26 million or less in the previous 3 years. So if you're in that category, there's a bunch of things you can do if you want to minimize your taxes. One might be if you're on the accrual basis, it might be more advantageous to be on the cash basis. And if you're under that threshold, you can switch from the accrual basis to the cash basis. Another one is that there's something that's called uniform capitalization for tax purposes. And what that basically is, it's sort of like cost accounting, where you're required to capitalize a certain amount of your expenditures related to inventory, thereby deferring your deduction. You have to capitalize it into your ending inventory instead of taking it as a current deduction. Well, if you're under the $26 million threshold, you don't have to be on unicap. So if you are on uniform capitalization, you can consider coming off of it, and that should save you some taxes. Another one of the small taxpayer methodologies is that under that methodology for small taxpayers, you don't have to carry inventory. What you could do, instead of treating your inventory and capitalizing your inventory, you can treat your inventory as a non-incidental material and supply, which basically what that means is, like, for example, if I bought 500 scanners, I couldn't expense all the scanners at once. As a non-incidental material and supply, I expend the scanners as they're used and consumed. So that's a methodology you can switch to if inventory, you don't want to track inventory. The next point is not for small taxpayers. It's basically for any taxpayer. So for tax purposes, we can only write off inventory at the end of the year if it's either you put it out for bid at a reduced price to the public, or you scrap it, or throw it out at the end of the year. So for book purpose, generally management will assess the inventory, and if they think that the market value is decreased, they'll write it down. For tax purposes, that's not good enough. You have to basically get rid of the inventory in order to get the deduction. Another tax saving method you could consider is switching your inventory methodology if you're on FIFO to LIFO, and especially in the current environment with rising inflation, the prices of replacement inventory are much higher. So what LIFO does, instead of costing out or expensing your oldest inventory, what LIFO says is you expense your most recent inventory. So in times of inflation, this would get you a good deduction. Another methodology you can switch to is the third point, which are advanced payments. So the general rule is that you would recognize advanced payments in the year of receipt, but there is a deferral method that you can adopt that says, hey, I'm going to recognize my advanced payment, and I get to defer it for a 1-year period. So I recognize it the same way that I recognize my financial statement deferred revenue, but I can only defer it to the next succeeding year. So it gives you a 1-year deferral if you switch to deferring your advanced payments. Another methodology you could adopt is to write off worthless debt. So if you have accounts receivable on your books, and this would apply, to an accrual-based taxpayer, not a cash-based taxpayer, because cash-based is you recognize the income when you receive it. But for an accrual-based taxpayer, if you have receivables that you have on your books that you're never going to collect, if you write them off, then you would get a bad debt deduction. Next one is for construction contractors. There is an election available for those that are on percentage of completion to be able to defer the income and expenses until the contract hits 10% completion. So that could be to your advantage if you're recognizing more income and expenses in the early stages of the construction contract. Also, a methodology for construction contractors they can take advantage of as a small business taxpayer is instead of being on percentage of completion, they could be on the completed contract method, which might be advantageous for some taxpayers. Another option available to you is, generally when you prepay your insurance, you would amortize it over the life of the insurance contract. What the tax rule says is if that policy is of a time period of 1 year or less, you don't have to amortize it. Let's say you have a policy that starts in the middle of June and goes to the next year. Normally, you would amortize the first 6 months and then takes the next 6 months in the next year. But what you do is you can adopt a methodology under tax that you're going to deduct that expense, that complete policy in the first year, and you don't have to defer the last 6 months to the succeeding year. And the last one is with regard to accrued bonuses that, often companies will accrue their bonuses after a year and then pay them at some point in the next succeeding year. Well, if you pay that bonus within 2.5 months of the next succeeding year, and that amount is determined fixed and determinable, meaning that the employees are pretty much guaranteed to get the bonus, that if an employee left, that the company wouldn't keep the money, that amount is fixed and determinable, or at least some portion of the bonus would be paid out. Then if you pay it within 2.5 months of year end, you could deduct it in the current year. So those are just some accounting method options available to defer taxes and to get deductions. Next slide.
Doug, especially these cash concepts that you're doing, cash-related concepts, or the write-off, the elections that are made. The problem is that you elect it the first year. The second year, you can't, you can do it. You're doing it again, but it's, you're almost like chasing the tiger after a while. After the
first. I mean, you're right. A lot of these, the reason they call them accounting methods is their timing method. So it's not going to affect the lifetime, the lifetime taxes you will pay. What you're going to get with a lot of these are deferrals, like a 1 year deferral. But, it can become like a somewhat of a permanent benefit, not entirely. But let's say, for example, you go onto LIFO, and as long as your replacement inventory, the inflation's increasing and your inventory is not, you're not decreasing your inventory levels, it can be somewhat of a permanent deduction.
And real quick, as it relates to the LIFO, because I know that some of the people on here, they're in a manufacturing business or something, they couldn't be experiencing inflation. The United States experience inflation. It may be in their industry. When can they affect LIFO? Begin 2022, or they have to do it next year?
So they could still adopt LIFO for 2022 because you just file what they call Form 970 with your tax return. The only catch is that if you adopt LIFO for tax, you must adopt LIFO for books because there's a conformity that in order to adopt LIFO for tax, you also must adopt it for books.
Okay. And if they're on IFRS, I have to bring accounting into this. If they're on IFRS doesn't have LIFO, so it's out.
Yeah, generally, if you're on IFRS, then you can't adopt LIFO because, as you said, that IFRS does not allow LIFO.
Okay.
No reporting.
Thank you.
So there are some tax benefits that are available for immediate deduction of business assets that you purchase and place in service in certain years. One of them is bonus depreciation deduction. And as you know, this was put into law beginning in 2001. And for tax year 2022, the bonus depreciation is at 100%. So if you place a property, an asset in service that has a life of less than 20 years, you can take 100% bonus depreciation and write off the whole thing the first year. This bonus depreciation is subject to sunset in 2027. And starting with 2023, it's going to go down 20% every year. So for tax year 2023, bonus depreciation will be at 80%. One of the great tax tools that you have to do planning now is if you're thinking of buying an asset and placing it in service begin in January, you may want to speed it up and do it in December of 2022. So you can take the benefit of 100% bonus depreciation. So if you take 80% bonus depreciation, it doesn't mean that the other 20% goes away. You deduct the remaining 20% over the life of the asset. But it would be more beneficial if you take the whole 100% in 1 year. Another way that you may be able to deduct the cost of the asset that you place in service is Section 179. And Section 179, not all assets will be eligible for that. The assets that the maximum that you can deduct under Section 179 for 2022 is $1,080,000, and the assets that you put in service in total in 2022 cannot exceed $2,700,000.
And Mariana, real quick about 179. I think that if a company is owned by a trust, or trust is one of the owners, shareholder or member, I'm not going to get into what trust can be, but they can't elect 179. Is that correct? Or they can't get a 179 benefit, right?
Correct. So the entity can elect to deduct under 179, but the trust does not get that benefit. So for trust, it doesn't get deducted. So on pass-through entities like S corporation and partnership, the Section 179 deduction is reported as a single line item, and it flows through to the shareholder or the partner. And then this limitation is calculated at the partner or shareholder level. So in some cases, when you don't know who your partner's personal tax return situations are, you may not be benefiting as much with taking Section 179D as if you were taking bonus depreciation. But there's one downside with taking bonus depreciation is that some states do not allow that, and there is an add back for bonus depreciation, and then you will get regular depreciation for those assets. Assets that can take bonus depreciation are the ones that have a life of less than 20 years. So machinery, equipment, land improvement, they are eligible to take bonus depreciation. The CARES Act has put into place one item that is very beneficial for owners of a building, and that was the qualified improvement property. Qualified improvement property is described as any improvement that you do in the interior section of a commercial building. So if you're doing a tenant fit up, anything that's interior of that tenant would qualify as for bonus depreciation. The life of that asset has been changed under the CARES Act to 15 years. So you can take bonus depreciation on that, this was one of the clarifications under the CARES Act. The other tax strategy that you can do as far as planning for the assets is that under the tangible property regulation that was placed in service in 2014, you can elect the minimum safe harbor, which it means that you don't necessarily have to go in and capitalize every single item that's you're purchasing during the year. So for taxpayers that do not have a financial statement, you can elect to deduct those fixed assets that regularly have to be capitalized up to $2,500. For example, if you go out and buy, you're going to change all your computers this year for your staff, and each computer is costing you $2,000, and you're buying 20 computers. The total cost of that would be $40,000, and in the past, you may have been required to capitalize those. But if you elect the minimum safe harbor, you will be able to deduct the $40,000 cost of computers that you're placing in service in the current year. That also is in the case for federal and state, so there is no add back for that. Another item that was under tangible property regulation is the partial disposition of an asset. So, for example, if you are replacing your entire parking lot and you will have to capitalize it, you can go back and calculate the cost of the parking lot by using an index number, inflation index number, and write off the old cost of the parking lot. So you're capitalizing the new parking lot, writing off the old parking lot, less all the accumulated depreciation, and that would be a benefit. The other regulation that was under the tangible property regulation that is beneficial, and the owners of buildings may be able to deduct those, is the under unit of property regulation. So what unit of property regulation does is that they were saying if you are replacing only a portion of your unit of property, you don't have to capitalize the whole thing. For example, a residential building may have windows that you're thinking of replacing. If you only replace 1/3 of the apartments, you don't have to capitalize that. You can expense it. One other thing that you can benefit from accelerating depreciation on your property that you place in service is use of cost segregation study. So if you are buying a new building or warehouse that you're placing in service for your business purposes, you can get a cost segregation study done by certified engineers. That what they do is they will go and look at the cost of your building or warehouse and allocate it among different lives. For example, like a 5-year asset, a 7-year asset, they will look to see if a portion of that building they can put in as land improvement. So those will have different lives of 5 years or 15 years or 7 years as compared to 27.5 years for a residential building or 39 years for commercial building. By doing this, as we spoke about bonus depreciation before, any asset that has a life of less than 20 years will be eligible for bonus depreciation. So you will get a big write-off on that. Also, one other benefit of the cost segregation study is if you want to do a partial disposition. Like the example that we just gave, if you are going to replace your entire parking lot, under the cost segregation study will break out the cost of your parking lot. And you can go back and use that number to write it off when you replace it. There's another study that can be done, which needs to be done by certified engineers. It's called 179D deduction. This is not to be confused with Section 179. 179D deduction is for energy efficient buildings. This is for commercial buildings, and what it will give, the benefit that it will give you is if you're building a new construction or doing improvements to increase the energy efficiency in your building, you may be able to deduct $1.80 per square foot. So you will get an immediate write-off of $1.80 per square foot, and you will reduce the cost of your building that you would otherwise be depreciating over 39 years. There is another credit available, which is called Section 45L. This is a credit, not a deduction, and this is for residential buildings, which is defined as any building, residential building that's less than 3 stories high.
Okay. I have to put out a poll because we're getting behind on the poll. So I'm sorry, I didn't mean to cut you off, but and my screen is frozen, so you couldn't see my face. And so let me put this poll out real quick. What are the tax issues of primary concern? You sold cap gains, tax rates, complexity of tax rules, and what's gonna as soon as we switch the slide, I'm gonna probably jump out of the seminar, come back in to unfreeze my camera too. So, but again, if you want to finish up the slide, Mariana, go ahead. I'm sorry.
Okay, so one last point on this slide is for section 45L, which is a $2,000 credit per units in an apartment building that's less than 3-story high. If the building is more than 3 stories high, then you will be able to classify that as commercial and take 179D deduction, which can also be beneficial.
After listening to all that, I'm not surprised that the poll says the largest concern is complexity of tax laws.
They are complex, but we're here to help you.
Okay. So our next topic is going to be concentrating on corporations and NOLs in usage. So under the Tax Cuts and Jobs Act in 2018, they made changes to the net operating loss. Under the Tax Cuts and Jobs Act, they said you can no longer carry back your NOLs to previous years like you could prior. And they put the NOLs that they would be limited to 80% of your taxable income, but they were carried forward forever. Under the COVID-19 rules, the limitations on net operating loss were temporarily suspended. So for 2018, 19, and 20, they suspended the Tax Cuts and Jobs Act and did allow companies to carry back their losses up to 5 years. But after 2020, there's no longer any net operating loss carrybacks. You have to carry them forward. And unlike under the previous law, the NOLs from tax years 2018 and forward do not expire. Pre-2018 NOLs, you have full utilization of the NOLs and they expire after 20 years. And the significance of that is that if you have an NOL in 2018, 19, and 20, normally, or 20 or 21, you would normally think that, hey, I don't have to worry about paying taxes because I have NOLs. Well, with this limitation, even though you have NOLs, it's limited to 80% of taxable income from NOLs from 2018 forward. So you may even, if you have NOLs, you may indeed have a tax payment to make. So keep that in mind. The next item is really concerning around the pre-2018 NOLs that expire after 20 years. And if they're about to expire, there's some things that you could do to bring more income into the current year to get as much uses as you can before they expire. So one can be, electing out of installment gain sale treatment. Normally under an installment sale, you recognize the income as you receive payments, but there's an election you can make to elect out of the installment sale and recognize all the gain, even though you haven't received all the payments. Another thing you could do is under the tax rules, if in the previous slide, I talked about ways that you could defer advance payments to the end of the next succeeding year. Well, if they're on that method and your NOLs are expiring, you might want to change your methodology to recognizing advance payments in the year of receipt. Another thing you could do, where we were thinking about tax savings ideas is, for a company to adopt LIFO. Well, if you have big what they call LIFO layers from your differences between what your LIFO and FIFO inventory would have been, what you could do is you could make an accounting method change to come off LIFO and adopt FIFO. And under that methodology, you would generally recognize the income over a 4-year period, but you would bring in 1/4 of the income in the current year to help you get as much uses as those expiring NOLs as possible. Next slide.
Yep.
So the next topic we're going to talk about is credits. And I think the first bullet point is, on the top of everybody's mind, or you're hearing all commercials about the employee retention credit and how you could get up to $26,000 per employee. So we're going to talk about that a little bit. First, going back to the history of the employee retention credit, it ran for the period from about March of 2020, and for most taxpayers to the end of September 2021. And the way you generally would qualify for the credit was one of two ways. One is you would have a significant, what they call significant decline in gross receipts, was defined differently for 2020 and for 2021. For 2020, a significant decline in gross receipts was if you compared any quarter in 2020 to a similar quarter in 2019, and you had a drop in receipts of more than 50%, you would qualify. And you would continue to qualify for the credit in 2020 until your receipts reached 80% of what they were in 2019. For 2021, the rules were slightly different. It was still a significant decline in gross receipts test, although they dropped the percentage to 20%. So you would compare any quarter in 2020 to a similar quarter in 2019, and if you had a drop of more than 20% in receipts, then you would qualify for the credit. And then they also put in there an alternative quarter test that you could look to the alternative quarter to see if you qualify. So, for example, in 2021, if I didn't qualify for the 20% test in the first quarter, I could go to the alternate quarter, which would be December of 2020, compare that quarter to 2019, and if I had a drop of more than 20%, I would qualify in 2020. And that alternative quarter test was allowed throughout 2021. The second way you could qualify is if you had a full or partial shutdown due to a government authority that prohibit you from engaging in commerce, travel, or group meetings, and it had to have more than a nominal impact on your business. So there wasn't really a bright line test for this government shutdown test. It was more of a facts and circumstances test. So that's how you qualified. So a lot of people are still hearing these commercials that you can qualify for the employee retention credit, even though it's ended for most taxpayers in September of 21, except for what they call a recovery startup business, which is a business that started in business on or after February 15, 2020, and had less than $1 million of receipts. But there's the ability, and these credits are claimed on your quarterly tax form 941, which is your payroll tax form. You claim the credits, and there's also an obligation, if you claim these credits, to go back to your income tax return, your federal income tax return, and reduce the salaries that you took on the return or the expense by the amount of the credit, because the government doesn't want to give you a credit and then also subsidize your deduction. So that's some of the requirements. But there are still refund opportunities, even though the employee retention credit ended in September of 2021, is because you can amend your Form 941 you filed to claim the credit. So you can file a 941X, you can claim your credits, and that opportunity is open as long as the statute of limitations are open. For 2020, you can claim employee retention credits up to February 15th of 2024. And for 2021, you have up till April 15th of 2025 and April 15th of 2024 for 2020. So with all this said about the employee retention credits, there's been some talk about a lot of providers that are encouraging people to take these credits. The IRS just recently came out with some announcements to say that, be careful, that make sure you qualify for the credits, because if you don't, you're subject to interest and penalties if you find out that you claimed the employee retention and weren't eligible for it because you didn't meet one of the two tests above. So a lot of people are talking about going out there and getting your employee retention credits. Just remember that you're ultimately responsible for your income tax filing. So just make sure you do your due diligence and making sure you qualify for the credits. And they also we've been hearing that, the IRS is going to devote a fair amount of resources to auditing some of these credits. So just be careful on the employee retention credits. Certainly take them if you're entitled to them, because they're a great benefit, but just make sure you are entitled to them. So
before you go to the next one, I have to put up another poll because it's 9:07 already. So I've got to put up a poll real quick. Have you or are you considering relocating to save taxes? So while they're doing the poll, Doug, you can go on with yours.
Sure. Another, valuable for credit for companies is what they call the research and development credit. So these are credits that are available for companies that are improving their products and processes. So if you're doing that, you may be eligible for research and development credits, and certainly it's something that you should take advantage of. And within the research and development credits, this is for like biotechnology and startup companies that aren't paying tax. So they have what they call a small business payroll research and development credit. And what that is for companies that are basically in the startup phase that had no receipts in the current year, and the average annual receipts in the 5 preceding years is less than $1 million. If that's your circumstance and you don't have any income taxes to pay, you can offset your payroll taxes. And in 2022, you could offset as much as $250,000 of payroll taxes. Under the recent tax law changes in 2023, that's increased to $500,000. So that's a valuable credit for some startup companies. Some other changes. This one actually took place in 2022. Generally, most companies would expense their research and development expenses. And this is not to be confused with research and development credits. We're talking about the expenditures. Most taxpayers would deduct them in the current year. Well, as of 2022, taxpayers can no longer deduct their research and development expenditures currently. They have to amortize them over a 5-year period if the research takes place in the U.S., or over a 15-year period if the research takes place outside the U.S. So just something to keep in mind there. And there also are what they call work opportunity credits that may be available to you. And what these credits are is based on hiring, disadvantaged, what they call disadvantaged workers. So somebody who's been on unemployment for a long period of time, veterans, certain disadvantaged youths, and a couple of other classes. So just keep in mind that there are credits out there. Just make sure you research them and see if any of these are available to you, because they can save you significant tax dollars.
Next slide.
All right, so Doug spoke about the opportunities for corporations. I'm going to be touching on some of the opportunities that you can have with the pass-through entities. As you know, the income and losses of a pass-through entity for partnerships and S corporations, they pass down to the shareholders or partners. And if a partner or shareholder is not active in that activity and they have large losses, they will not be allowed to deduct those losses in the current year, and it will carry forward. So if, in some of the activities, if you think that you will keep on having losses and these passive activities will keep on carrying over, you may consider disposing of that investment. So all the prior year passive activity losses will free up once you dispose of that investment or activity, and you can make that deduction in the current year. Another opportunity that was available for the shareholders of an S Corp or partners was what was known as qualified business income deduction, or Section 199A, that came as of the Tax Cuts and Jobs Act. And what it is that if you qualify based on certain limitation, the partner may be able to deduct 20% of the income of that pass-through activity from an S corporation or a partnership. So what you want to do with the planning, as I said, this is subject to some certain limitation based on the income of the individual. So for an S corporation, you may have some tax planning opportunities. If you think that the individual shareholder will have a high income that will put him above that limitation that they would be eligible for that 20% deduction, you may want to reduce their salary from that S corporation in 2022. So their income level will go below that threshold and they would be able to deduct that 20%. There was another item that was under Tax Cuts and Jobs Act, and that was the excess business loss limitation. And what it meant was that an individual cannot deduct more than a certain amount in 1 year from all the activities related to a partnership or an S corporation. That limitation for 2022 for individuals filing as married, filing jointly, is $540,000, and for single tax filers is $270,000. So if the combination of all the income and losses from pass-through entities add up to be more than $540,000 in loss, they will not be able to deduct the excess loss in 2022. And the excess loss will carry forward to 2023, and that would be subject to that annual limitation, which Doug just mentioned. They would only be able to deduct 80% of that loss carry forward against their other portfolio or salary income. So you may want to do some planning around that. This was supposed to sunset, but the Inflation Reduction Act has extended it another 2 years, and it will expire in 2026. There's also a limitation on the amount of interest expense that can be deducted at a S corporation or a partnership level. This was also a result of Tax Cuts and Jobs Act. In 2022, that limitation is 30% of the adjusted taxable income of that entity. Prior to 2022, the adjusted taxable income of that partnership was calculated by adding back interest expense and depreciation to the net income of that entity. But starting with 2022, you can no longer add back the depreciation and amortization expense to arrive to your adjusted taxable income. So the threshold is much smaller now, and the 30% deduction for interest expense is a small number that you can deduct. But any excess will carry over to the following year until the individual taxpayer, has income from that partnership to be able to deduct it. So you may want to do some planning around that. If you you may be able to accelerate the income in 2022 to be able to increase that deduction limitation.
I'm sorry, I thought that was next slide. Go ahead.
So there are some opportunities for large taxpayers that are subject to this 163J. I forgot to mention that not every taxpayer every entity is subject to this 30% limitation. Only if your average prior 3-year receipts are more than $5 million, which is adjusted for inflation every year. So some of the entities that are subject to 163J, there is an election available to them for the real estate profession entities, which is entities that are renting the buildings. And they can elect to be a real estate trade or business. By making that election, you will not be subject to Section 163J, and you will be able to deduct your entire interest expense. But there's one downfall with that, is that you will not be able to depreciate your building under makers. You will have to elect ADS. And what ADS does is that makes the life of your building for a commercial building to 40 years instead of 39 years. And for the residential buildings, you will have to depreciate it over 30 years. The other thing is that for qualified improvement property that is in a commercial building, you will not be able to take bonus depreciation. So you need to weigh your pros and cons to see which one is more effective for you. If you elect out of 163J and not take bonus depreciation on your QIP, or if you be subject to that 30% limitation.
Okay, right before that, because I don't want to cut you off in the middle of the slide, I'm going to put up the last poll because we're at 9:17 and we're going to be losing people around 9:20. So just want to make sure we put up the last poll. What topic are you interested in hearing about? Taxes, estate and gifting. Please pick accounting. It'll make me feel good. Legal and insurance. Okay, you guys can go into pensions as they're voting on the slide.
Sure.
Okay.
So
Do you want
tax,
to go through these briefly so we can get to other slides also?
yeah, no, this is going to be real quick. So with regard to pensions, previously before the Secure Act, you had to have your pension plan for most pensions plans, like a defined benefit plan, set up before the end of the year. Now, under the Secure Act, you could set up your plan up. You have up to the due date of your return, including extensions, to set up and fund your plan, so you could get the deduction potentially in 2022 if you do that. Below are just the dollar limits for defined benefit plans for 22 and 23, which are 245,000 and 265,000 respectively. And then the third point, they have, for older taxpayers, they have catch-up provisions for 2022 and 23, which are 61,000 and 66,000 respectively. And, a good pension plan for your sole proprietor or single member LC is what they call a simplified employee pension plan, which you could get a deduction up to 25% basically of your earnings, and you could fund that, and you could fund that in 2023 up to your due date of your 22 return, including extension. So it's just some in pension plan opportunities. Next slide. So we're just going to talk about some employment tax matters, just some stuff, housekeeping to keep in mind that, 2% S corporation owners, that fringe benefits should be included in their W-2s. They're not like normal employees, where it would be non-taxable. Partners should not be taking W-2 wages because purposes of being a partner, you're considered self-employed, not an employee. Payroll deferral. So if you deferred your employer payroll taxes under the COVID-19 provisions, where you deferred it for 2 years, half of that deferment was supposed to be paid back in 21, and the other half was due in 22. So make sure you do that by year end if you deferred your payroll taxes. And I meant 2023 was 2022 was the other half too. Just last point, employers can reimburse their employees tax-free up to $5,250 for student loan debt through 2025. So just some pension employment tax matters to consider.
All right, so now we're going to be talking about some state and local tax opportunities that you can do. Because of the Tax Cuts and Jobs Act, the limitation on how much you could deduct for state and local taxes that you paid on your itemized deduction is only limited up to $10,000. So a lot of states have implemented the pass-through entity tax. It started with Connecticut, New Jersey has that. And what it does is that you can pay the state taxes at the entity level for pass-through entities, S corporations, and partnerships. This way, the entity will get a deduction for that state tax that's paid, and the taxpayer will get a credit for those tax payments on their state tax return. This is very beneficial. Federal taxes have accepted this. As I said, a lot of states have adopted into this. California, New York, now New York City has a pass-through entity tax. You need to make the election on a timely basis, on an annual basis. So if the entity does not make this election, they may not be able to get the benefit of this. There has been some changes for New Jersey. Now for 2022, if there is an overpayment of pass-through entity tax, they can carry it forward to the following year. Also, some of the partnerships, if they have non-residents and they have non-resident withholding requirements for New Jersey, now they can use the pass-through entity tax instead of the non-resident withholding tax.
Okay, so just maybe some things regarding the pass-through entity tax. That was a provision that's been put in by probably about 30 states now, and it's a workaround to the $10,000 SALT cap. It gives a business the ability to make an election to deduct what would otherwise be paid at the shareholder level, the ability to the entity to pay the state taxes at the entity level as opposed to the shareholder level. So we're just going to go through some recent developments in California, New York City, and New Jersey. So California made some tweaks to their pass-through entity tax elections. One, now single member LLCs can make pass-through entity tax elections. And the other favorable change they made is in the original, when they originally put in the credit, that the pass-through entity tax credit came before the tax credit paid to other states. Now they've corrected it, so now you get to use your tax credit paid to other states before the pass-through entity tax credit comes through. So that was a favorable provision. For New York and New York City, so New York and New York City's now adopted a pass-through entity tax election regime similar to New York. And originally it was supposed to go into effect in 2023. But they changed it a little bit to say if that you made a pass-through entity tax election for New York for 2022, that would also give you the ability to make to be able to make the pass-through entity tax election for New York City. And the other favorable they said that if all your residents were New York State residents, then you can you can calculate the pass-through entity tax on your entire income. Same for New York City. Previous to that, you were only able to, you would have to apportion your income to New York, and then you would pay your tax and get your credit based on that. So if you have all New York and New York City partners or shareholders, you could get to take the tax and the credit based on 100% of your New York income from that entity. New Jersey's favorable provisions came out as New Jersey at first was making you, if you made a pass-through entity tax election, generally you basically paid your tax for that entity. But New Jersey also required you to still do non-resident withholding if you were a partnership. They removed that provision. So now if you pay your New Jersey pass-through entity tax, you no longer have to do non-resident withholding on that partner. Unfortunately, California did not make a similar change. So on top of the pass-through entity tax that you pay, you still have to do non-resident withholding. And we just wanted to emphasize the importance of making these pass-through entity tax elections timely, because if you don't make it, you really potentially lose a permanent benefit of being able to deduct your state taxes at the business level that are not limited, as opposed to the partner or shareholder level that are limited to the $10,000 SALT cap. Little thing, some information about Nexus. A lot of employees are now working remote, so just be careful. That could create Nexus. Found out, last year or so that, for example, in New Jersey, where a lot of people were working from home, but would normally have commuted into New York, a lot of taxpayers thought because I was just working in New Jersey remotely that my wages were not subject to New York tax. New York sent out a lot of letters to people saying, well, no, you're not. If your home base is in New York, even though you didn't step foot in New York for any of the year, your wages are still subject to New York tax. So remote employees is a growing field, and it could pull your company, your business into Nexus or having to file state returns in that state. And then, a lot of states are adopting the concept of economic Nexus. Generally, you have to have a physical presence to be subject to tax in a state. Now, more states are going to if you have a certain number of employee payroll, property, or sales in a state, they deem you to be doing business in their state. So just be careful of that. Lastly, New York had come up with a capital cost credit tax program for small employers that reside in New York City, their business in New York City, they have 100 employees or less. They could potentially get a $25,000 credit for up to $50,000 expenses for their COVID-19 expenses. And you have to have under $2.5 million of gross receipts to qualify as a small business, and that basically the expenditures would be from January 1st of 2021 to 12/30 to basically to the end of the 2000, and that's it for.
Okay, so we don't have much to talk about on the international part, except that the K2s and K3s were requirements to be filed with the S Corps and partnerships in 2021. The proposed filing instruction that is for 2022, they have some easier requirements that not a lot of entities will be subject to that filing. So if you don't have a partner, if you don't have any foreign activities, if you don't have any foreign partner, you may not be subject to that filing. So this was a great relief for a lot of tax preparers that now they don't have to scramble and prepare all those forms where there was not a lot of instruction on how to do that.
But a partner could ask for them, but they have to ask for them by like August 30th or something weird,
So
right?
now, based on the proposed instructions of the form, the draft instructions, it says that if you don't file a K2 and K3 and the partner comes back and say that they require this form, you can prepare that form and give it to that partner, but you don't have to go back and amend your tax return. So that's a big, great news so far this year for K2 and K3s.
So now we're going to move on to the Inflation Reduction Act. I'm going to just touch on these next two topics briefly because they generally apply to very large taxpayers. So as part of the Inflation Reduction Act, there's now a 15-minute minimum tax on the profits of large corporations, and they're generally defined as any corporation, and it only applies to corporations that for their 3-year period had average annual gross receipts of over $1 billion. For companies owned by that have a foreign parent, the threshold is $100 million. So they consider it adjusted financial statement income because there are certain things that are allowed from tax. You could replace book tax depreciation for book depreciation, and they also allow you to use your alternative minimum foreign tax credit. And companies owned by private equity companies and certain manufacturing companies are excluded from these provisions. So very large corporations that these apply to. Most people don't have to worry about this one. This next provision is also for very large companies. There's a 1% surge charge on corporate stock buybacks, and what that basically is your treasury stock. When corporations are redeeming their stock, there's a 1% surcharge on the fair market value, and it only applies to publicly traded companies. But in addition, also applies to a company that has what they call affiliated corporations or entities that they own 50% or more. It could apply to that as well. Planning note is that if you want to avoid this tax and you were thinking about buying back the stock, you'd want to do so by December 31st of this year to be able to avoid it before it comes into effect.
So there was a lot of talks about making a lot of changes under the Inflation Reduction Act, but there was not as many passed through. There's a lot of incentives for green energy. One of them was they expanded on Section 179D that we talked about. For 2022, the green energy that you can get on a commercial building under 179 was $1.80 per square foot, but now they have changed it. The taxpayer can get up to $5 of deduction per square foot, and there are certain requirements that needs to be made. It may be more beneficial to some, but based on the employees that they have, it may not. There are other tax energy save credits for electric vehicles, which can be up to $7,500 for individual for purchase of a new electric vehicle. There are energy credits for the biodiesel fuel. There's clean fuel tax credit for users of windmills and things like that. So in Inflation Reduction Act, there was a lot of green energy tax credits and savings, which are going to be effective for 2023. That's about it. Doug, do you want to say anything else on this slide, or?
Oh, what's that, Mariana?
I said, was there anything else you wanted to add? That's.
No, I think that's about it.
Yep. That brings us right to 9:30. I don't see any other questions come in. Let me see real quick. No. So Mariana and Doug, I want to thank you for all this information. There's a lot of information. There's the credits that are out there, and I know that New Jersey has a credit that they came out with too for investments in. And a question came in. I'll ask real quick right before we have to wrap it up. But New Jersey, I think, has a credit that's out there for equipment purchases. But Angela said, I heard if you apply for ERC credits, you'll have to amend your past returns. Is that correct? And I believe you said that before, Doug. And also, Doug, there's a video out that you did on our website, too, dedicated to ERC. So I'd recommend people check that out. But for Angela's question, do you have to amend your past returns?
Yes, you do. So if you if you choose to take the employee retention credit and you amend your federal payroll tax return, you're obligated in the year that the credit belongs to go back to your federal income tax return, amend it, and reduce your salary and wages by the amount of the credit.
It's insanity.
Yeah.
Yeah. So, all right. So Doug and Mariana, again, I want to thank you very much for doing this. This is a lot of information. I know it took you a while to try and pull together all this information. If anybody has any questions, please reach out to them. They really know a lot of these topics, especially these credits that are coming through. Don't miss them. I want to thank everybody for watching. And again, if you have any ideas for topics, let me know. We'd love to present stuff that are of interest to you. The presentation is being recorded, will be available, and we will be sending out a link to all the registrants. And if you didn't get a copy of the handout, which are in handouts that you can download by hitting the download link, we could send you a copy of that too.